Welcome to Christine's Finance and Investment channel. In today's video, we're diving deep into the world of ETFs or exchange-traded funds, and more specifically, the top 10 most popular ETFs around the globe. These aren't just some random ETFs, these are the heavy hitters, the ones known for their massive size, incredible liquidity, and broad market coverage. Whether you're just starting out with a few $100s, or you're a seasoned investor with a six-figure portfolio, there's an ETF out there for you. So are you ready to explore the world of popular ETFs and see how they can supercharge your investment journey? Let's dive right in. All right, let's kick things off with a true titan in the ETF space, the Spider S&P 500 ETF Trust, better known by its ticker symbol, SPY. If you're even remotely familiar with the stock market, you've probably heard of the S&P 500. Think about companies like Apple, Microsoft, Amazon, Google. These giants are all part of the S&P 500. And when you invest in SPY, you're essentially buying a tiny piece of all of them. SPY is massive, with trillions of dollars in assets under management. Because it's so widely traded, SPY is incredibly liquid. This ETF is like the reliable friend you can always count on. It's not about getting rich quick. It's about steady, long-term growth that's designed to weather market ups and downs. If you're looking for a simple, low-cost way to get started with investing and track the performance of the US stock market, SPY is definitely worth considering. It's a classic for a reason, and it could be a valuable addition to your diversified portfolio. Let's explore the exciting world of emerging markets with the iShares MSCI Emerging Markets ETF, or EEM. EEM takes you to countries like China, India, and Brazil. These economies are growing rapidly, offering incredible investment opportunities. EEM allows you to diversify your portfolio beyond the US, but investing in emerging markets comes with risks. Political or economic instability can impact your investments. For growth potential, EEM is a compelling option. Let's talk about an ETF that covers the entire US stock market, the Vanguard Total Stock Market ETF, or VTI. VTI is like owning the entire league, from the biggest players to the up-and-coming rookies. Thousands of stocks, large, mid-sized, and small, all in one ETF. Broad exposure to the US economy, from tech giants to consumer brands. Known for its low expense ratio, VTI lets you keep more of your returns. For broad exposure and long-term growth, VTI is a strong contender. All right, now let's talk tech, shall we? If you're bullish on the future of technology and innovation, the Invesco QQQ Trust, or QQQ, might be right up your alley. This ETF tracks the NASDAQ 100 index, which is like the who's who of the tech world. We're talking about companies like Apple, Microsoft, Amazon, Google, Facebook, Tesla, the disruptors, the innovators, the ones shaping the future as we know it. Investing in QQQ is like placing a bet on the continued dominance and growth of these tech titans. Now, it's no secret that the tech sector has been on a tear in recent years. From smartphones and social media to cloud computing and artificial intelligence, technology has revolutionized the way we live, work, and interact with the world. But here's the thing, past performance is not indicative of future results. However, if you believe that the future is digital, that technology will continue to shape our world, and that the companies in the NASDAQ 100 are well positioned to lead the way, then QQQ could be an exciting addition to your portfolio. Just remember, as with any investment, diversification is key. All right, let's shift our focus back to international markets. But this time, we're heading to the developed world with the iShares MSCI EAFE ETF, or EFA. While EEM focuses on emerging markets, EFA targets developed economies in Europe, Australia, and the Far East. Think about countries like Japan, the United Kingdom, France, Germany, Switzerland. These are economic powerhouses with established markets and a long history of global trade. EFA gives you access to a diversified basket of companies from these regions, allowing you to participate in their growth and stability. By expanding your portfolio beyond your home country, you're spreading your risk and reducing your exposure to any single economy. EFA is like the seasoned traveler of your portfolio, exploring different cultures and bringing back a wealth of experience. So, if you're looking to broaden your horizons, diversify your portfolio beyond US borders, and participate in the growth of some of the world's most advanced economies, EFA could be a valuable addition to your investment toolkit. Just remember to do your research, understand the risks involved, and make sure it aligns with your overall investment goals. All right, let's stick with the theme of international developed markets. But this time, we're looking at an ETF that specifically excludes the United States, the Vanguard FTSE Developed Markets ETF, or VEA. Think of it as EFA's close cousin, offering similar exposure but with a slightly different flavor. VEA tracks the FTSE Developed Markets Index, which includes companies from Canada, Europe, and the Pacific region, but excludes the US. By excluding the US, you're ensuring that your portfolio isn't overly reliant on the performance of a single country. VEA introduces your portfolio to the unique characteristics and growth potential of developed markets outside the US. From automotive giants in Germany to luxury goods makers in France, VEA offers a diversified slice of the global economy. So, if you're looking to complement your US holdings with a purely international developed market ETF, VEA is definitely worth considering. It's like adding a touch of global sophistication to your portfolio, broadening your horizons, and potentially enhancing your long-term returns. All right, let's circle back to the familiar territory of the S&P 500, but this time we're looking at a low-cost alternative to SPY, the Vanguard S&P 500 ETF, or VOO. Both SPY and VOO track the S&P 500, giving you exposure to 500 of the largest US companies. The main difference lies in their expense ratios. VOO boasts a lower expense ratio than SPY, meaning you get to keep a slightly larger portion of your returns. Now, you might be thinking, how much of a difference can a few basis points really make? Well, over the long term, even small differences in fees can compound significantly, impacting the overall growth of your investments. VOO is a testament to Vanguard's commitment to providing low-cost investment options for everyday investors. So, if you're looking for a simple, cost-effective way to track the S&P 500 and participate in the growth potential of the US stock market, VOO is definitely worth considering. It's like the frugal friend who helps you save money without sacrificing quality or experience. Let's explore small-cap companies with the iShares Russell 2000 ETF, or IWM. IWM focuses on companies with significant growth potential. It's like owning a portfolio of promising startups. These companies are often more volatile. IWM is like the venture capitalist of your portfolio. All right, let's continue our journey around the globe with the Vanguard Total International Stock ETF, or VXUS. This ETF is like the ultimate travel companion, offering broad exposure to global equity markets, excluding the United States. If VEA is like visiting developed markets, VXUS is like exploring both developed and emerging markets, giving you a truly comprehensive view of the world. Think of it this way: VXUS is like having a passport to every corner of the globe, allowing you to participate in the growth and innovation happening outside the US. From bustling cities in Asia to emerging economies in South America, this ETF captures the potential of a globally connected world. By excluding the US, you're ensuring that your portfolio isn't overly reliant on the performance of a single country. So if you're looking to broaden your horizons, diversify your portfolio beyond US borders, and participate in the growth of the global economy as a whole, VXUS is definitely worth considering. It's like adding a touch of global spice to your portfolio, broadening your horizons, and potentially enhancing your long-term returns. All right, let's wrap up our journey with a return to emerging markets. But this time we're looking at a cost-effective option, the iShares Core MSCI Emerging Markets ETF, or IMG. Remember how we talked about EEM offering exposure to emerging markets? Well, IMG is like EEM's budget-friendly sibling, providing similar exposure at a lower cost. Both EM and IMG track the MSCI Emerging Markets Index, giving you access to companies in developing countries with high growth potential. The main difference lies in their expense ratios. IMG boasts a lower expense ratio than EEM, meaning you get to keep a slightly larger portion of your returns. IEMG is a testament to the increasing affordability of emerging market ETFs. So, if you're looking for a cost-effective way to tap into the growth potential of emerging markets, IEMG is definitely worth considering. It's like finding a hidden gem in a bustling market, offering value and potential in one compelling package. That wraps up our deep dive into the top 10 most popular ETFs globally. We've explored a diverse range of investment options, from tracking the S&P 500 and the Nasdaq 100 to venturing into emerging markets and diversifying across the globe. If you found this video helpful, don't forget to give it a thumbs up, share it with your friends, and subscribe to the channel for more investing insights. And be sure to let me know in the comments which ETF you think is the best for long-term investment. Thanks for watching, and I'll see you in the next video.